While there have not been many major tax changes this year, shifts in your personal circumstances can mean the rules apply in new and sometimes unexpected ways. Here to share some of the most common areas where Canadians can be caught off guard this tax season is Nicole Ewing, Principal Wealth Planning Office at TD Wealth. And Nicole, welcome to the show.
Oh, great to be here.
Great to have you back.
Thank you, thank you.
And right in the middle of tax season, so to start off, why don't you give us a brief overview of who might be affected and what sort of life changes could potentially impact your tax return?
Well, this is where people need to realize that it's not always the legislation that is going to change your taxes year over year. It might be something like you acquired additional foreign property this year, and maybe you have additional U.S. securities that are going to bump you over that $100,000 reporting threshold. Or perhaps you had medical expenses this year that you didn't have in previous years, or you had some last year that you might be able to claim this year. And it might not just be you, it could be members of your family, it could be your spouse, it could be your children, it could be broader members of your family as well. And another one that really catches people off guard is becoming common law. So moving in with a spouse, a partner, boyfriend, girlfriend, and discovering that all of a sudden CRA is treating you as you are a spouse for tax purposes. And all of these can impact your credits, your benefits, and the position that you can take with respect to filing your taxes.
All right, so let's talk foreign investments. What exactly is the CRA asking for when they want to know whether you have more than $100,000 outside of Canada in foreign investments?
So they're looking at whether or not you own or hold specified foreign property that exceeds $100,000 total, so not just one particular security that you own, but all of them combined. And they're looking at that at any point in the year. So this is not a December 31st date, at any point in the year if you had this specified foreign property. And that includes things like US securities, for example, that might catch people off guard. It does not include those same securities if they're held in a registered plan, however. So some nuance there to the definition. It also doesn't include personal use property. So if we're thinking here, I own a property in the US or I just purchased a property in the US, fret not, that doesn't apply to you. This is specified foreign property. If you're curious about that definition, easy to find it on CRA's website.
And if someone was supposed to file that form and but didn't, what happens next? You know, what kind of penalties could they be looking at?
So the T1135 is your foreign income verification statement, and we need to file that if we are over that $100,000 threshold. And if you don't, we're looking at pretty severe penalties. So $25 a day, up to $2,500. If it's considered gross negligence, we're at $500 a month, up to $12,000. And if it's gone over 2 years, so if we're past that 24-month period, we could actually look at 5% of the total cost that you might owe in a penalty.
Okay, let's talk medical expenses, because it's not just from the January to December period, but for any 12-month period ending of the tax year. So how do you choose a window to maximize what's claimed?
So you are able to choose any date that ends in 2025, any 12-month period that ends in 2025, provided you haven't already claimed those same expenses in 2024. If you haven't claimed them, you might be able to claim them this year, as long as you are over the threshold, which is 3%, the lesser of 3% of your net income, or in 2026, it's $2,834. So provided you're over that amount, that threshold, you can choose any of that period, and it's really a matter of math. So you may not have been over that threshold last year, may have left some money on the table. This year, we're gonna go back and see whether or not we can collect some of those 2024 expenses, bring them into 2025. And it's not only for yourself either, it could be for your spouse, your minor children, we're going to include theirs. If you have financially dependent family members outside of your immediate family, so your parents, your grandparents, nieces, nephews, theirs may also be able to be included. So looking at financially dependent, that definition is really critically important.
Now, one of the things that I find hard is keeping track of all these medical expenses. What are some of the common medical expenses that people forget to keep track of or keep receipts of?
There are so many, aren't there, that it could be. I always think of eyes, ears, nose. So we have, our anything related to our hearing, our eyeglasses, our dental treatments, private healthcare amounts that we spend, out-of-country amounts that we might spend. One that doesn't often get recognized is if you need to travel more than 40 kilometers to receive this treatment, you can actually claim that as well. But again, it's not just yours, it's your family members. And those circumstances may have changed year over year. So if you're looking after a parent this year and maybe you're taking them to their their appointments that might be 40 kilometers away, diving in and really understanding the nuances. It's so broad. Some things do require prescription, so things like CPAP or an air conditioner, for example, or an air filter can actually be a medical expense, but you do need to have a prescription for that. Very, very long list of opportunities. So again, available on the CRA website with a pretty easy search, and it will pull up a laundry list of expenses that you can claim.
All right, and just to clear things up, what is considered common law status for tax purposes, and how can that impact a couple's tax filing?
It's such a good question because it's different than what it is for family law purposes or estate law purposes. So from a provincial perspective, it might be 2 or 3 years. From a tax perspective, it's actually just 1 year. So living with your spouse or living in a conjugal relationship for 12 months can see you now being deemed to be a spouse for tax purposes by the CRA. And that can have really big impacts, not only on the credits and the benefits that you might be able to receive, but the filing positions that you can take. So things like the attribution rules start to apply, where you can't just gift back and forth to each other without that income being attributed. Maybe pension income splitting opportunities are available to you now that you are spouses, something to keep in mind. The superficial loss rules will apply to your spouse that hadn't otherwise applied. So the definition of spouse, that 1 year, and it's not a choice, Anthony. You can't just choose whether or not you're going to claim to be common law. If you are in that conjugal relationship for more than a year, you will be deemed to be a spouse. And I heard just this week of somebody being caught off guard when they reported later on, we've became spouses, and their spouse actually, their new common law spouse actually had some benefits clawed back and needs to repay the CRA for some money because they hadn't reported it properly.